Jessica, please take it away.
Thank you so much. I super appreciate the intro. Yep, that's me. Been working with my fellow nerd co-founders for over a decade. We were all computer nerds at MIT together, and yeah, we're in the saddle with our third company, Pilot, solving a problem that, frankly, we experienced as founders for our previous companies, which is like, how do you take care of your financial back office, especially if you are not by training someone with a finance or accounting background. So that's me. So I'm in the same boat as probably most folks on this call, which is, you know that you need to, your job as a founder is to set up the business for success. That involves in part managing your finances. How do you do it? So one of the most important things that you can do as an early stage startup is you can practice good financial hygiene. And, what do we mean by that? This is everything from kind of choosing the right institutions to making sure that you have the right visibility into your finances to make good choices. But this is some real brass tacks stuff that, nobody told me in a class that I wish I had known when I was starting my first company. And so we're excited to talk about this today, and really the tactical brass tacks things that every small business owner, every startup founder should be thinking about to make sure that you are doing your job, which is maximizing outcomes for the business. So we're going to talk about each of these things in turn today. How to set yourself up for success from a financial perspective when running an early stage startup. At a high level, a couple of items that we're going to discuss. This includes everything from banks and credit cards, what to do about minimizing commingling of business and personal expenses, kind of how to get paid and how to pay people. And having the bookkeeping and financial reporting you need for compliance purposes, for tax purposes, but then also for management purposes and fundraising. And that's what we'll cover today. So why is this so important? And just to be explicit about it, and the reason why I want to be so explicit about it is because, I think in our experience, a lot of founders don't take this seriously enough, and it really does impact the business, and it impacts the ability to fundraise. So I want to be sort of clear up front about why this is so important. First and foremost, it's the only way to have an accurate view into the financial health of the business to make the best business decisions. If you don't have good books, you don't really know what your cash burn is. You don't know what your runway is. Like, these things are really, really important. Having good financials, so the underlying data being accurate, and then having the appropriate reporting on top of that data is necessary for fundraising and to keep investors happy. And then from a compliance perspective, it is in fact required to file accurate taxes. It helps you avoid legal and liability issues. So this is super, super important. Here's how to start off on the right foot. So first things first, it's important to choose the right financial institutions. And I say this in part because it's pretty easy to not do that. And so we want to make sure that you're choosing the right financial institutions. For example, appropriate banks and appropriate credit cards. One key thing here is it's important to choose an appropriate business bank and an appropriate business credit card. And this matters for the security and the functionality of these institutions. There's a difference between personal and business accounts. So for banks and for credit cards, you want to choose an institution that has read-only delegated access to your accounts for bookkeepers. You want to make sure that these institutions can do the things that you need them to do. Are you getting a good interest rate if you're going to park a boatload of money in your bank account? Are you going to be doing a lot of wires, a lot of international wires? Will it support your needs in that space? What are the reporting capabilities? On the credit card side, a really common issue for startups is, you're growing quickly. You need a credit limit that's going to grow with you. Like, are you going to be able to issue credit cards to new people easily as the business grows? Are you going to have the controls that you need on spend? Are you going to have the credit limit needs that you need? So it's really important to choose an appropriate bank and an appropriate credit card. I have a couple of recommendations on this slide, but I think that the framework for this is, what do you need out of your banks? What do you need out of your credit cards? And make sure that you get them from a business bank account and a business credit card. And then once you have a bank account, you have a credit card, it's important to use them. And by that, I mean, so there's a very common early phenomenon for businesses, which is, you don't have a bank account yet, you don't have a credit card yet, so you're spending personal money on the business. And at the very beginning of the business, that's okay. That's okay, but you really want to keep it to a minimum. You want to stop doing that as early as possible, and you want to keep track of any commingling. So if you are buying anything on behalf of the business, or, and this does happen, if the business is buying anything on behalf of you, you need rigorous documentation on that. And that needs to be reflected in your books as loans or liabilities between you and the company. And the reason why this is so important is that you want to make sure that you don't have any tax issues. You want to make sure you don't have any audit issues around commingling of business and personal expenses. If you're the IRS, you don't want to see, these opaque transfers between the business and a person, that is seemingly not payroll, but is something else, right? So keep the IRS off your back. Don't create tax issues for yourself. And even more importantly, make sure that you have a clear view of the business's health by not having the waters muddied by kind of these movements of money between kind of your personal accounts and your business accounts. So the long and short of it is, keep this to a minimum. Commingling of business and personal expenses, keep it to a minimum. Part of the point of getting a business bank account and getting a business credit card is that you don't have to do this. And keep track of any commingling that you do have so that's reflected appropriately in your financials, so it is not a tax or audit risk. Okay, but you got your bank account, you got your credit cards, you're stopping commingling because you're being responsible. What else? Well, you want to use professional systems for everything else, right? So for bookkeeping, for payroll, how are you paying your contractors? How are you getting payments from customers? Are you invoicing them? Are they paying you through Stripe? How are you managing reimbursements? You have equity. Do you have a cap table? You have inventory. Do you have an inventory management solution? It's really important to use actual financial institutions for these things. And I say this and I emphasize it because I can't tell you how often I hear from founders, I don't need Expensify. Like, I don't want to pay for Expensify. Like, I'm just going to track this myself in the spreadsheet. Oh, I don't want to pay for Carta. I'm going to keep track of my cap table myself in a spreadsheet. I'm going to, I haven't set up a payroll system yet. I'm going to I'm going to pay, we're just going to transfer money to people right now. We'll set up a payroll system later. And here's what happens with this. First off, when you don't use real financial systems, it actually takes more time for the founders to do this work and to administer this work. And founder time is one of the most precious things that a startup has, and it's really important that you are able to focus your time on the things that are the highest leverage for the business. The other thing that's true is that if you aren't using real institutions, you'll make mistakes, and those mistakes can be costly. If you're paying someone outside of a payroll system, you're not probably withholding the appropriate payroll tax, and that will come back to bite you in the ass. You definitely don't want to have any misunderstandings around equity that could have been avoided by using a real cap table management tool. And it's totally irrational to say, I'm not willing to spend $5 per month on Expensify for expense reimbursement. Your time is so much more valuable than the $5 per person per month. So the cost savings justifications actually don't make sense. You set up good financial hygiene, good financial processes on good financial systems to save yourself time and money, and to set up a strong foundation that the business can grow on top of. Don't make your life harder by trying to DIY any of these things, or to try to save don't try to be cheap. It's worth paying for any of these systems to set you up for success for the future. So I hammer this home because I really can't have another founder telling me I'm too cheap to buy Expensify. That truly does not make any sense. It's worth it. It's worth it, and the time savings for you alone is worth it. So use real financial institutions. And then when you have good financial institutions, you have a payroll system. You have your bank, you have your credit card, you have a payroll system, you're running your payments through Stripe, you're invoicing through Bill.com, you have reimbursements through Expensify. That's great. That's great. What are you going to do with all of this data? Well, the key thing to do is you want to start bookkeeping early so that you have that holistic, integrated view of the business's financial health. Okay, start bookkeeping early. Why is this important? Accurate financial data helps you make better decisions. It also helps avoid tax errors. Number two, it's the basis for critical financial reports, for management visibility, to run the business, for fundraising, for board meetings, and for investor updates. You know, good books are foundational for reporting on metrics that investors care about, and good bookkeeping is a sign of maturity. We want to come off as mature to our investors and our teams. Also, it's less painful to scale if you start when it's simple. I truly, the number of times that founders have come to Pilot and said, hey, so here's the thing. I haven't had books for the past 2 years. I also haven't filed my taxes for the past 2 years. Can you help me? And yes, we can help you, but how were you running your business in the meantime? Were you really making the best decisions without having clarity into your burn and your runway and your liabilities and your margins and everything else that comes from having clear and accurate books? Start bookkeeping early. It's good discipline, and you want good discipline for maximizing your business's outcomes. When you set up bookkeeping, especially if you're a startup, it's important that you have accrual basis books. And accrual basis, this is in contrast with cash basis. Accrual basis accounting means recording transactions as they occur, versus cash basis, which records transactions when the money is actually paid or received. So for example, let's say that you have a startup and you sell a subscription for some kind of service, and you have annual prepayments. In a cash basis view of the world, when a company pays you, $1,200 as an annual payment for, an annual plan of some kind, cash basis, all of that money is recognized on the books. It's recognized as revenue all in the month that it was received. Even though the company, your customer, is going to use a service from you month over month for the next 12 months. And you have an obligation to that customer to deliver that service. And, really the service is being used up month over month. That money that they gave you is being used up month over month as you deliver a service to them. So cash basis records that deposit all at once, versus accrual basis accounting, where we recognize the transactions as the service is actually delivered. So if a customer pays you $1,200 for it's a 12-month annual prepayment for a year of service, really you're using up $100. You're providing sort of $100 worth of service month over month. We're recognizing that revenue month over month, $100 per month spread over a 12-month window. And why do these two bases exist? Like, when do you use one or the other? Cash basis is very simple. It's just cash inflows and outflows, dead simple. Accrual basis, though, gives you a more accurate picture of your business. It captures who you owe money to, your accounts payable. It captures who owes you money, accounts receivable. And as you are delivering goods and services to your customers, you can associate the spend on that service delivery or that product delivery with the revenue that's being recognized to have more accurate views into your profitability and the relationship between revenue and spend. Because accrual basis bookkeeping gives you a more accurate picture of your business, it is what investors for startups expect. And also many standard metrics, for example, margin, are kind of derived inherently from accrual basis books, where you need to know what service was actually delivered and what was spent for that service delivery to compute your gross margin, your gross profitability. So investors expect accrual basis books, so give them accrual basis books. And also it's good for you, for management purposes, to understand how your revenue, how your profit margin are trending over time. Additionally, the IRS requires accrual basis bookkeeping for certain business sizes and types. You'll eventually get so big that you have to have accrual basis books, so might as well start on the right basis to begin with. So you set up bookkeeping, you have great, clean, accrual basis books, you are good to go. And now you start having customers. Fantastic. You want to make sure you can get paid. And there's actually a lot of thought that needs to go into how you get paid by your customers that I think sometimes we don't pay enough attention to. Because how you can get paid, the payment terms, can have a big impact on the perception of the service by customers, and also your kind of collections process and the operational aspects of getting paid. So here's some examples of this. So one thing that you have to decide on at some point is your payment terms. Are you selling a service that is prepaid? Are you selling a service that is paid in arrears? How can people pay you? Is it like the Wild West? They can pay you with a wire and a credit card and Bitcoin, and they can walk over and deliver a check into your mailbox? Probably not, right? There are probably some bounds on what payment methods should be acceptable. both to minimize collections issues and to have a reasonably streamlined collections process for you and your team. So you're gonna have to make decisions about the payment terms. When you are communicating these payment terms to customers, or you're sending an invoice to a customer, make sure that you have all the information that you need for accurate bookkeeping. Like, what are the dates of service delivery? We need to know the service period for a service that's being rendered, if this is some kind of subscription service. You need to know enough about the customer to be able to kind of reflect customer details in your books, in cohort analyses, etc. So make sure that you have enough information to have accurate bookkeeping and whatever modeling and reporting you need on top of the books. You also want to make sure that the customer experience is positive. Look like a pro. Don't hand roll a PDF, use a tool for this that looks professional and complete and easy to use. You'll then also want to set up a regular accounts receivable processing cadence. So even if you have prepayments, but certainly if you have payments in arrears, what happens if someone doesn't pay you? Like, they're delinquent on a payment. How much do you try to get them to pay you before you give up and you write it off as bad debt? If you're invoicing and you need to actually, have them, it's not automatic. It's not like, oh, a recurring Stripe credit card payment. They actually need to like wire you money or ACH you money. On what cadence are you sending these invoices? On what cadence are you confirming who has outstanding payments to you? You're going to need an accounts receivable processing cadence. So start to think about that and have a plan for collections. What happens if someone doesn't pay you? How hard do you try to get that money back? So make sure that you can get paid. Very important. And once you've got books, you've got money coming in, you're on top of your spend, make sure that you have the right tax preparer, especially as a startup. So startup taxes look pretty different from kind of traditional SMB taxes. So you should make sure that you are using a tax preparer that is familiar with taxes for startups. One reason why that's important is because you want to make sure that they're experienced with any credits that you intend to claim. For example, most startups, if you have any kind of real R&D, are eligible for a federal and state R&D tax credit, which is basically free money. So you probably want to claim those things, right? You want to make sure that you have a tax preparer that you can work with who understands these things. Under no circumstances should you DIY business taxes. The penalties for doing them incorrectly can be significant. This is doubly true if you are in any kind of international situation, if you have founders who are not operating in the US, if you have a multi-entity situation, there can be very large, like on the orders of $50,000 penalties for even just specific filings that were not done in a timely fashion, depending on your circumstances. So do not DIY business taxes. Leave it to the pros. Okay, but you've got your books, you've got your taxes, kind of tying it all together. So first, what should your books be able to tell you? And even this is, for me, I didn't come from a finance background. I'm an engineer by training, but every founder should be able to, derive and understand the following things about their books. And step one is have good, clear, accurate, useful books prepared by a professional bookkeeper. But then, what should you be able to read from that? First things first, your first job as a founder is to make sure that you don't run out of money. So make sure that you can understand from your books, from a cash burn report, do we have enough cash to cover our near-term costs? And when do we need to fundraise to make sure that we don't run out of money? And you can back out from that, company milestones to make sure you're on track for a fundraise, right? But first things first, don't run out of money. What's your cash position? The next thing is costs. So, we're spending money to deliver a product or service. We're also spending money on general operating expenses, payroll, etc. How are my COGS, so my product and service delivery costs, and also my operating expenses changing, and why are they changing? Is that all understood? Is it all under control? And then how about growth? How is revenue growing? And how is gross margin trending on top of your revenue growth? And finally, are we on track to hit our business goals? Like, is anything going unexpectedly that would undermine our ability to hit our next major milestone, which is probably a fundraise? So make sure that you and all founders on your team, everyone on the executive team, know all of these things, and you know them because you have clean books. And finally, we've covered a lot. Like, we've talked about a lot of things, and some of these things are pretty serious. They're pretty scary to get wrong. And they were news to me as a first-time founder, frankly. The number one thing that I would share with founders who, they're kind of like unsure how to approach this space is get strategic help if you need it. Like, this does not all have to rest on your shoulders. You do not need to be the person who's doing the books yourself or like calculating all these metrics, producing all these forecasts on top of the books yourself. Your job is to maximize the outcomes for the business. And if getting strategic help running your finances helps you do that, you should. Both to save you time and to make sure that you have an expert lens on how these things should be evolving as your business grows quickly. So for example, if you need a budget or a headcount plan that feeds into a budget, you need forecasting of various revenue or spend scenarios. You need a KPIs dashboard. What's my profit margin? These cohort analyses, all kinds of analyses on top of the books. The structure and the content of board decks. Like, if you need help with any of these things, you should know that you can get help with them. You don't have to do them yourselves. You may also want advice on various financial topics. Like, hey, I'm spinning up a sales team. I know that they should be on some kind of commission structure, but I don't know a ton about what that should look like. What is the market data? Like, give me some feedback on what other companies are doing for sales commission structures in my domain. Fundraising strategies. When to fundraise, how much to fundraise, what the content of that talk track and deck should be. Miscellaneous compliance concerns, like, hey, COVID, we had an office in San Francisco, but now folks have kind of dispersed to all corners of the United States. Am I on top of any tax, payroll tax, other compliance concerns? You should probably talk to somebody about that if that's a concern that you have. Just in general, don't be shy about getting strategic help with your financial back office in particular. Your job is to maximize the chance that the business will be successful. So do it by having the pros pay attention to this. You don't have to hire an expensive full-time in-house person. You can get a fractional CFO. You can like size engagements with providers to what you actually need, but do make sure that you are getting the strategic help that you need to run the business. And why is this so important, right? So companies without good financial hygiene, what happens? Well, they spend significant time and money cleaning up their books. They get fined for tax mistakes. You can't trust your numbers. You don't have accurate projections. This leads to scrambling during fundraising. You then have difficulty fundraising because investors don't believe in the rigor or the maturity of the finances. And then you can also get in legal hot water, which includes personal liabilities in some cases. We don't want to live in that universe. We want to live in this universe. We want to be companies with great financial hygiene, where we, are making efficient use of our time. We're spending less time on the books because they're done right the first time. We have avoided legal and compliance issues. We're successfully claiming all this free money that's now available to startups. We truly understand the business and are able to make realistic projections based on accurate underlying data. You have what you need to fundraise successfully, and you impress investors with your financial maturity. We all want to impress investors and our teams with being on top of our stuff. So this is how we want to be. This is why good financial hygiene is so important for startups. And that's why I've dedicated my professional life to it. Okay, so that's my pitch to you all. I'll go ahead and stop sharing and we can do some Q&A. Okay, and then I don't know if Jamila or Alex, if this is where you hop in or.
Yes, thank you, Jessica. It took me a second to get back. Thank you so much. That is so informative with so much valuable information for all the startups and founders here. I've given an opportunity for a lot of the attendees, to be able to post their questions. I didn't have that many, but the ones that did come up, we could start with those. So I had Steph Davis ask, I have a preclinical biotech lab business. What is the buy form for a term sheet?
And sorry, am I able to see this question or is it?
Yes. It's actually in the chat for the session tab.
Oh, got it. Yeah. Perfect.
It's not in the Q&A tab. Sorry.
Got it.
Here, I'll repost it at the bottom.
Got it. And then, Steph, I'm not sure what you mean by the buy form for a term sheet. Are you asking about what? Can you say, I guess, can you clarify your question? I'm not sure what you mean by that.
Okay, well, Steph responds to that. We could tackle a different question from Marco Cohen. If we do not start bookkeeping early, what would be some tips to catch up?
Yeah, I mean, the main thing is just catch up as soon as you can. So get aligned with a good bookkeeper, and maybe also a good kind of financial advisor, like a fractional CFO, who can make sure that if there's any cleanup that needs to happen, that's happening ASAP. So if you don't have books, step one is you need them for taxes usually, unless there's really minimal activity. So let's make sure you're compliant from an income tax perspective. And then let's make sure that you have what you need to run your business. So get a bookkeeper ASAP is what I would say.
Perfect. I think that's definitely one of the moral conclusions of this whole presentation. Another questions that we have, are there resources on Pilot's site or elsewhere that cover the foundational stuff you've covered today, example, checklist and recommendations? By Chris Miller.
Yeah, we do. We have a blog that has some of this information. We also have a quality check that you can perform on if you have books and you're like, how are they? How are we doing here? You can, and we can maybe find a link and send this in the chat. We can do a health check on the state of your books and your finances, and have that be actually like a tailored one-on-one conversation. So if that's of interest, reach out to info@pilot.com and we can hook you up. Yeah.
Perfect. Another one. Yes, it's right there. So Steph, term sheet for early stage firm. I think she clarified is the type of term sheet.
Got it. Yeah. So, okay. So maybe the fact that you're in preclinical biotech may or may not influence this answer. The most common, so if you're a startup, you want to take like venture money and your plan is to be a venture-backed business, like that's your fundraising strategy, as opposed to like loans or venture debt or something else. The most common thing to raise on initially is a SAFE. If you like SAFE, if you're not familiar with SAFEs, like Google for like SAFE fundraising and get the details. It's a very simple instrument, and it doesn't require having a valuation for the business. It's like kind of pre-priced rounds, a mechanism to do really easy, like low legal cost fundraising. And it's very, very standardized. For example, basically everybody who goes through Y Combinator, I think maybe any like 500 startups, Techstars, I think they basically are all raising on SAFEs. And usually what happens after a SAFE round is you end up moving to priced rounds where you have like a priced seed or Series A. The alternative to a SAFE would be a convertible note, but I'd say that SAFEs at this point are common by more common by like an order of magnitude. At least what we see in our, we do the books for over 1,000 startups, and that's what we see.
Perfect. Thank you. Jessica, I hope that answers the question. Jessica, I think my question would be, why would startups like avoid this besides expense, or is it laziness, not a know-how, or not really knowing who to go to do this?
I don't think any founders are lazy, but I think it's a combination of, yeah, if you don't feel like you have a provider who you know and trust, it seems like an impossible choice to make, to know who to trust to support you on your finances. That's one challenge. I think there's also some amount of maybe not fully understanding how powerful it is to have good books and like someone who can advise you on financial strategy as you're fundraising. I think sometimes founders get in the mindset of like, I'm doing it myself, right? Like I'm a founder. I'm like, I've got to raise money for the business. I don't know how to do this, but I'm going to figure it out. And I think people maybe forget sometimes you actually could just get help with these things.
Yeah.
And if you knew that you could, you would.
Of course. And what are some of like the biggest difficulties, let's say, or challenges that they face when they do start facing the books? Like maybe a story you could share with us from founders, or challenges, milestones that they need to know before they get into this if they haven't already.
Yeah. So let me share an anecdote about maybe not having good books in place, and then one where, like, even if you do, it's like this strategic piece of this on top of the books. So literally this week, and I'm here to support them and make sure they're successful. But I swear I had founders who came to me this week and they're like, we didn't plan to fundraise so quickly, but we have inbound interest from an investor. We don't have any books. Like, we've been around for 12 months. We don't have any books.
Wow.
They're going to ask us for our books. What is the fastest that you can get us books? And it's like, okay, we're here. We're going to take care of you. But it doesn't have to be a scramble. And then it's like, they don't know what their margins are. Like, they don't know what their runway is. Like, hopefully it's not surprising when we produce the books to then present to the investors, but just save yourselves the heartache. Do it early, because you never know when you're going to need them. Even if you only care for compliance purposes, you never know when something like this is going to happen. So just like be proactive so you're not scrambling. So that's one thing. The other example that's really common is you're like, cool, I have books because I've heard Jessica spiel about how I need to have books. Fine. But I don't pay attention to them because I'm like busy. I'm like a product person. I'm busy building the product and I'm not paying attention to this. And then what happens is you're like, oh crap, I'm running out of money. And I'm like, cool. This is why it's really important to work with a fractional CFO to be like, okay, here's where I am today. Here are the milestones that we'll need to complete, like metrics milestones, revenue milestones, what have you, to raise the next round. And then we need to manage the business to having the runway to be able to achieve those milestones between now and the next round. So we have a plan, we have a strategy in place for how we're going to manage the business, the spend of the business, what headcount expansion is appropriate, etc. We're tracking our margins. They're not as good as we want them to be, but here's a strategy for how to improve them by driving down costs over time. Here's a strategy that ensures that over the next 12 months or over the next 18 months, we're gonna hit all of those milestones to have a successful next fundraise. You want to have that. Like, you want to be having those conversations. So it's like phase one is have the data, like have the books. But really, I want more founders to get to phase two, which is like actually use them to drive a strategy to hit your next milestones. And I think sometimes it's like you get busy, you're busy with the product, you're busy with hiring, and you forget about it. And then you're surprised that now you need to scramble and raise on worse terms because you didn't understand what your burn actually was, or you didn't have enough time to actually improve the metrics as you intended to.
Definitely. And Jessica, that definitely goes into a question because Chris writes, at what point in a startup life does pilot make sense? Revenue level or some other marker? When do they know, like, it's a red ticker, I should be contacting pilot?
Yeah, sure. And look, you don't have to use pilot. Obviously, I'm biased. I think we're great. But from a compliance perspective, I mean, you need to be filing your taxes. So from a compliance perspective, you really should be engaging a bookkeeper before your first tax event, right? At an absolute minimum. And then on top of that, I would say as soon as you have like raised any kind of seed funding, and it's like, okay, what are we going to do with that money to get to the next fundraising event? I would bring on a fractional CFO to make sure you're building a plan around that.
Definitely. Thank you. And Martin, so what are founders supposed to track at first in terms of unit economics and metrics? If you haven't answered that already, it's in the Q&A tab.
Yeah, got it. Oh, I see what you mean by that. Got it. So yeah, and I would associate this with kind of what milestone kind of what phase of the business are you in. So if you're a seed stage company, mostly investors are investing on the dream, right? Your priority is like painting a compelling narrative about a problem that you are solving that is going to make a bunch of money. That's fine. But as you get to an A, as you get to a B, as you get to a C, there are different types of financial metrics, but also other metrics that you need to be demonstrating. Like the A and the B are about demonstrating product market fit and then the ability to grow. And by the C, you need to have a story for your metrics being healthy. You can't have negative margins while raising a C unless you've really managed to convince investors that that's appropriate, right? Like you need, by the time you're raising a C, you need to understand the core metrics for your business for sure. You're a SaaS business. What are your what's your revenue growth rate? What are your margins? But what is your net expansion? You know, it depends on what vertical you're in, but there are like a set of classic financial metrics and investor metrics that you're going to care about. So I'd say it's like seed, it's fine to sell on the dream, but you need to have a real problem that you're the right team to solve. You're convincing folks that you'll be successful. For an A, it's about demonstrating growth. And then for the B, it's about getting these metrics in place and mature so that by the C, you have like good unit economics for what you're doing. And that's like a general statement. Every business is different, but I'd say take a look at it as a kind of what fundraising stage are you in, and that will typically drive what you need to be reporting on. And also investors will ask for these things of you. Your investors are going to ask about your margins when you're raising a B, for sure.
Thank you, Jessica. And maybe a question that I have to go with that. Marta, I hope that answered your question. Do you ever confront, startups not wanting to share certain financial information because they don't want the investors to know, the insides and outside of that? Or like, is that something that they confront, or maybe why they don't want to approach the books in the first place? Because just like we had a session about resumes, and there was like a 40% saying that people are not honest on their resumes. So is it the same in the books?
Yeah, I would say that if you as a founder are ever like avoiding finance and accounting topics because you're like afraid of what the truth might be, you should immediately lean into it and make sure that there are not surprises. There are not surprises about your burn and your runway. There's not surprises about your margins. You're not surprised about what liabilities you have. Things like that. Like lean into it. If you feel any type of anxiety as I say this to you, you should like lean into it immediately. I will say that there's there's some amount of massaging of some types of metrics that happens. And I'm not saying that's good or bad, but the reality of a business's finances ultimately comes out in some like basic metrics like your burn. And so you can't hide for that long, and therefore it's good to just be honest with yourself about the numbers so that you can plan accordingly.
Perfect. Well, okay, that definitely answers that. Thank you, Jessica. I think we've answered all the questions. If anybody has anything else, please post it now. We do still have some time. Otherwise, Jessica, would it be okay to share your handle with all the attendees? Maybe they will connect with you or sign up, or I shared your Twitter handle. But if there's any other way that you prefer for them to connect with Pilot, please let's share it with them.
Yeah, absolutely. I mean, I think that because depending on the nature of your question, I would say if you email info@pilot.com, we will route you to the right place. I'm also easy to find on the internet. If you want to DM me on Twitter or email me, that's totally fine. But I would say in general, to make sure that the right person answers your question, info@pilot.com is a great place to reach out.
Okay, perfect. Well, thank you so much, Jessica. It's been a true pleasure to have you. And thank you everyone for attending. Hopefully we'll see you around at Global, our upcoming one, which we'll be announcing soon. It was amazing to have you. Thank you so much. And thank you everyone.